Let's bring in Gerard Cassidy, RBC's head of US Bank Equity Strategy. Gerard, always great to catch up with you, sir. Before we move on to the loan theme, the JP Morgans of this world, can we sit on Goldman? Can you grade that quarter for us, Gerard? Your view?
John, that was one of the best quarters that they've ever put up. Not only did they have a very strong investment banking number, their markets business was extraordinary. So here's a company that's delivering very strong results. It's the premier investment bank. We'd also point out, even when you back out the private equity investment gains they've reported, which came in at about $3 billion, just over $3 billion, you back that out of the total revenue, and the revenue numbers still were very, very strong at about $14 billion. Again, if you back that $3 billion out. So overall, very strong quarter. They're the #1 investment bank just about in the world, and it showed up in the quarter here.
Shanali mentioned the pipeline. Can this continue? Do you think it can?
That's a good question, John, and it's a tough prediction because it really has a lot to do with what's going to go on with interest rates and what's going to go on with the economy. If we see interest rates move up much more quickly in the next 3 to 6 months, the long end of the curve, that is, I think that would affect capital markets in general in a not unfavorable way. So that would affect the pipeline. But right now, pipelines are strong. We should especially look out, John, going forward for the M&A pipeline, because I see that picking up. And I think JP Morgan touched on that on their call this morning as well.
Goldman's had a great year today already. We had some weight to that rally. Morgan Stanley getting a lift going into earnings over the next couple of days too. Gerard, we have to go back to basics. We're getting an understanding of what the year ahead looks like, maybe even 2022 as well. And we ask ourselves a basic question in the market. What are the kind of companies we want to own in that environment? For you, Gerard, you have to answer the question, what are the kind of banks, the kind of business models I want to own? Now, a couple of weeks ago, I've asked that question. People would be saying JP Morgan, the regionals, anyone with exposure to this domestic economy, and not so much the brokerage business and investment banking. Gerard, what's your view now?
When you take a look at the next 6 to 12 months, John, I think the universal bank model still rises to the top. Yes, the investment banking results were very strong this quarter. It will be tough to sustain this level. Already in talking on the JP Morgan call, they indicated that the equity trading numbers in the second quarter may be more similar to the second quarter of 2019, not 2020. So when we look at the outlook for the banks, the universal bank model and the traditional commercial banking models are the models that should benefit from a stronger economy. Eventually, loan demand will come back. And on top of that, a steeper yield curve would benefit the net interest margin later this year.
Well, let's start with volume, and then we can talk about profitability, Gerard. Let's start with the volume story, loan demand. We know the consumers are cashed up. We can see that in the savings rate, and we can see it through the fiscal relief they've had. We know the businesses, the companies are cashed up because we've had an explosion of issuance over the last 12 months as well. They don't need the money right now. And that's because the economy is good and they've got money. And I think that was the point Jamie Dimon was trying to make, Gerard. Typically, we talked about muted loan demand. We'd be talking about a rough and tumble economy. That's not the story right now. As this goes forward, have you got a timeline for whether those conditions persist or whether they start to be eroded as the year continues?
I think what we have to look at, John, is GDP nominal growth. Historically, loan demand, loan growth in the U.S. banking system mirrors the nominal GDP growth numbers. So if the Fed is correct that we're going to see 6% growth, real GDP growth this year, let's include 2 to 3% inflation. So we're looking at 8% total nominal growth. I would suggest that by the end of the year, the fourth quarter, as companies are building out plant and equipment, as inventories are being rebuilt, as consumers draw down on their savings and spend, I think you'll see the loan growth start to annualize out at the nominal GDP number by the end of the year. That is what's happened over the last 75 years. I don't think that linkage has been broken. Now, it may be a little more delayed in this cycle than past cycles, but we do expect to see that growth show up at the end of the year and into 2022.
To what degree do you think that traditional relationship has been distorted by the fiscal relief we've had?
Yeah, you put your thumb right on it, John. It's that fiscal relief, the deficit spending, the quantitative easing. It has pushed out liquidity that is unprecedented today. And that is the real breakage that we've not seen before. Now, again, if this economy takes off the way we all think it will, that liquidity will be used up and borrowing will come back. later this year and into 2022.
This is the volume story. Let's talk about profitability, Gerard. We talked about the net interest margin. These banks got a helping hand by what we saw in the bond market over the last several months. That story stalled out since the end of March. When you look at margins right now, Gerard, do you see a continued push to cut costs at the likes of, say, Wells Fargo?
I think what is going to be interesting is that when you look at the margins for the industry, they've benefited, obviously, from the very strong investment banking businesses. And if you look at the profitability levels, the ROEs are incredibly strong this quarter. Obviously, they'll come down. As we go forward, I think what we're going to need to see pick up is the net interest margin. And that net interest margin continues to be under pressure for the industry due to the excess deposit growth. And that deposit growth is coming from the Fed's quantitative easing, but also due to deficit spending. So it's our anticipation that from a margin standpoint, net interest margins are going to continue to remain under pressure, and that should start to ease up toward the end of the year. Regarding expenses, expenses are trending higher, partly due to the volumes that are being generated in the investment bank, bringing on more incentive comp. But we also are seeing higher technology spending. So the spending is going to continue, and the banks are really going to need to get the revenue growth to manage the margins on relative to expenses later this year and into next year.
I know you've got a tremendously busy morning, Gerard. I'll let you go in just a second. Final one from me. Top pick in this sector right now, still B of A?
It's still Bank of America, John, and from the results we saw today, their investment banking numbers should be strong. The loan loss reserve releases were gigantic today. We should see that from Bank of America and others, and that will continue throughout the year, and that will carry the earnings over until loan growth picks up later this year and into next year, in our opinion.